I'm Dr. Dharmadhikari. I have completed my ICWA and PhD in 2012. I am teaching this subject for last 20 years. Now we are going to start with financial accounting and I will introduce the subject to you. The main thing, as you must know, is called accounting is a language of business. So as we know, business is we are here to learn about business administration or management of business. So when you say business, there are n number of activities, that is purchase, sell, maybe of goods, manufacturing of goods. So there are n number of activities in a particular day. Now suppose a businessman do not record any of these activities. What will happen? How he will come to know how much goods he has purchased, how much money he has spent, how much money he has earned. So he will be in dark. He will not be able to know how his business is going on. So financial accounting, the main thing of financial accounting is to record the business transactions systematically in the books of accounts. So that steps we are going to learn in these subjects one by one. Now we will see definition by American Institute of Certified Public Accountants. Accounting is the art of recording, classifying and summarizing in a significant manner and in terms of money, transaction and events which are in part at least of a financial character and interpreting the results thereof. Now we will see the meaning of these definition one by one. So first is it is art of recording. Why it is art of recording? Because everyone will record his own expenses, income in various ways. Suppose you are writing in a diary. Someone will write on the right hand side of the diary. Someone will write on the left hand side of the diary. The way of writing will be different. Someone will write rupees first, then the description. So it is an art of recording. Then if you all transactions are taken together, they are classified on some uniform basis. So classifying and then summarizing. The businessman at the end should get some conclusion how his business occurred in a particular period. So summarizing. The manner is also uniform. So in a significant manner and in terms of money. In accounting, we are concerned with money only. So the transaction and events which are in part at least of financial character. So it should be in some monetary terms. Then we consider them of recording in financial accounting. So and then interpreting the results. So these are the various steps which are completed in financial accounting and we are going to see thoroughly in the whole syllabus. Now objectives of financial accounting. So every activity has to have some objective. So first objective is to keep systematic records. So as I have given example that if the businessman do not record his transactions on day-to-day basis, what will happen? He will forget. So suppose he had received some cash from as commission and he did not record, he will forget. Then he has to spend a lot of money on various expenses, rent, electricity bill, telephone bill and so on. If you do not record day-to-day basis, he will forget. So financial accounting compels the businessman to record systematically each and every business transaction. Then ascertain the financial results of the business. Now as day-to-day expenses are going on, every business activity go on and on. So at a particular time, the businessman has to take review what has happened in his business. So the financial results are ascertained at the end of financial year so that the businessman comes to know that whether his business has earned profit or incurred loss or what is going on and what is the space of improvement. Then to ascertain the financial health of the business. So how healthy the business is, how much cash the business is having, what are the assets, what are the liabilities of the business. that the businessman has to know about at the end of the financial year. So he will come to know financial health of the business, and it helps in decision making. Of course, any activity related to business, that must be helpful in decision making. So these are the objectives, and to fulfill these objectives in financial accounting, there are certain books of accounts which we are going to see in detail. So for recording business transactions, there is journal. For classification, there is ledger, and final accounts to know the ascertain the financial results of business. So it consists of trading and profit and loss account and balance sheet. So these statements are the conclusion of the business during a particular financial year. Now we are going to see functions of financial accounting. So first function is recording, that we have seen in the definition. Recording business transaction systematically. Now what is business transaction? So business transaction means when a particular owner of the business spend some money and get some things for business, then it is business transaction. Now suppose the owner has paid money for which is not for any business activity, then it will not be called as business transaction, and it should be completed. For example, a prospective customer came to the business and he put an order. Now, this is incomplete transaction. You cannot record. It is not a business transaction. Only placing order for the quantity, for a certain quantity, is not business transaction, because there is no money transfer. When he will buy the goods, then only it will called as business transaction, and it will be recorded in the books of accounts. Second step, now to fulfill this particular objective, a book of accounts is designed, which is called journal. Journal means day-to-day recording of transaction. The word jour in French means a day. So every day the businessman has to record whatever business transactions happened in his business. Now what will happen? In journal you will get all business transaction date wise. Now, if the journal is given to you and you are asked to find out what are the sales made during the month, will you able to do that? No, because it is all transaction day wise. So it will become very difficult to identify all the sales transactions happened in a particular month. So the businessman wants quick figures to make decisions. What are the purchases made in a month? What are the sales made? What are the office expenses? So to fulfill this objective, the next book is designed, which is called ledger. So the step or the function is called classifying. Without classification, you will not able to get any figures because they are scattered over day wise. Now you must be using passbook for your bank account. What it is a ledger account in the books of bank. What you come to know, what are the transactions happened in your own account, how much money you have deposited, how much money you have withdrawn from the bank, and what is the balance in your account, which is very important for you to make decisions. So it is called classifying customer wise transactions. Same way, in a business, each and every account is opened separately. That is purchase account, sales account, office expenses account, and all journal entries are posted to ledger. Now, when you come to know for a particular account, furniture account, you will come to know what is the balance in the furniture account. So that is the purpose called classifying. All transactions are classified in ledger accounts and they are balanced at the end of certain period. So next function of accounting is summarizing. So when the accounts are classified, you are interested in the balances in that account. For example, what is the land and building balance of the business? What is the machinery available, furniture, cash balance? Then what is the amount of, what are the debtors, what are the creditors? That is called summarizing. So each and every ledger account is summarized in a trial balance. So presenting the classified transaction in a manner useful to the users is called trial balance, which is summarized. After summarizing, the next step is analyzing, because the businessman is doing this whole activity for making the decisions to get review what is going on in his business. So analyzing. The recorded information is analyzed to make useful interpretations at the end of accounting period. Means what is the profit made by the business, or what is the loss suffered by the business, what are the assets, what are the liabilities, etc. And they are called final accounts. All the final accounts are prepared at the end of the year. That is, in India, we follow 1st April to 31st March as accounting year. And then last function maybe is communicating. So whatever are the results of business, they are not for only for the businessman, they are for all the stakeholders which uses this particular financial statements. So all information is communicated in a proper way to the stakeholders, which is called annual report of the company. So in case of a joint stock company, the shareholders are the owners, and they have a right to know how the money invested by them is utilized by the business. So annual report is a form of communication to the outsiders, to all stakeholders. So this particular information is a public information. On website of every company, you will find annual report, which is the summary of all financial accounting, and it is communicated to all stakeholders. Now we are going to see how this financial accounting activity is carried out. So for any particular activity, there should be a base. That is, on the principles, the whole building of accounting is put up. So which are these principles? Without principles, the particular activity cannot be fulfilled in a proper way. So there is a need of common principles. Now if the common principles are not there, what will happen? Everybody will do the accounting in his or her own way, and there will not be any uniformity, and the profits identified by various business will not be at par. So to bring uniformity, there is need of common principles. Accounting concepts and conventions are designed for this purpose, and they are called generally accepted accounting principles, that is GAAP. So in India, we follow Indian GAAP, that is, these principles are accepted all over India. In that, first we are going to see accounting concepts. Now, concepts are the assumptions or which are you have to follow while making the particular any journal entry or any particular assumption which is followed uniformly. So first we are going to see business entity concept. Now what is entity concept? Now what happens when you say business? There are two parties, owner and business. Now if you see, when a particular owner runs a business, what happens? Actually it is his own business. So physically there is no diversion of owner and business. But for accounting purpose, we have to assume that business and owner are separate business entities. Why this assumption is required? If you mix these two, the profit of the business will not be correct. So we will take one example. Suppose owner invested cash into business. Now actually physically owner and business are same. So we will not record this transaction. As what you will assume, owner and business are same, so there is no need to record this transaction. But practically it is not true. When there is transaction between owner and business, you have to record it as per business entity concept. So this is called capital in business. Now, why there is these two are taken separately? If it is mixed together, then the result, which is called profit or loss, will not be the same. So they are treated separately to get the figure of profit clearly. Now suppose owner withdraw cash. He has withdrawn cash for his personal use. If this concept does not exist, you will take it as the same. There will not be any entry in the books. But as they are separate entities, you will record these transactions in the books of owner, which is called drawings. Thus, this concept helps the business to find out figure of profit accurately. So, as per business entity concept, all transactions are taken into the books of business and not in the books of owner. And when there is transaction between owner and business, they are recorded separately. So, generally two type of transactions are there: capital and drawings. So, this is called business entity concept. What are the advantages of this concept? This concept helps in finding out figure of profit accurately. Now we will go to next concept, money measurement. As the name suggests, there are two aspects of this concept. First aspect is each and every business transaction is measured in terms of money. So, for example, purchased 500 units at rupees 10 each. Here, you will not record 500 units because they are in terms of units. You will measure in terms of money. So it will be rupees 5,000. You will not record 500 units, but you will record its money's worth. That is rupees 5,000. So you will record, make the transaction of rupees 5,000. Each and every transaction is measured in terms of money. So you will pass the entry for purchased goods for rupees 5,000. This is the first aspect. Now second aspect is if you cannot measure in terms of money, you will not record the transaction. For example, the managing director of company left. As you know, this particular transaction you cannot measure in terms of money. So, but it affects the business. When any top authority lefts or dies, it affects the business as they are the decision makers. But this you will not record because cannot measure in terms of money. So this transaction as per money measurement concept will not be recorded in terms of money. Now we will see cost concept. As the concept says, the cost is recorded in the books of accounts. So, for example, when business purchases any asset, its cost price is recorded. So, for example, machinery purchased at rupees 5 lakh. In suppose year in 2017. In 2017, it will be recorded at cost price. What happened? In 2018, its market value becomes 5,20,000. As per cost concept, you will not consider market value of the asset. You will only consider cost. So it will be recorded at 5 lakh. And then you will go on charging depreciation. On fixed asset, you charge depreciation. So by following the method which is applicable by the Income Tax Act, which is allowed, you will charge depreciation on 5 lakh at a particular method, and then you will record the asset at cost price always. You will never consider market value. That is called cost concept. Initially purchase cost and then after depreciation. But market value will not be considered. That is called cost concept. Now next concept is going concern. Actually this is assumption. Going concern concept is basic assumption of business. What is the assumption? The business will go on and on for a very long term. So you must be knowing that certain companies have completed more than 100 years. How it is possible? Because it is assumed that the business goes on and on for a very long period, though the owner changes, though the owner dies, though it will take over by another person, but it is the basic assumption. Now, how it is applicable? So, whenever any transaction is made by the company, any contract, any agreement is made by the company with any other company or any other business, what is done? It is basic assumption. We do not consider it also. So, the assumption is the business will go on and on for a very long period of time. Without this assumption, lease contracts of 100 years are not possible. When there is any long-term agreement, we use this particular assumption. So it is the basic assumption that the business will go on and on for a very long period of time. So the contracts of more than 50 years, 100 years lease contract, all these are possible only because of this assumption. Next is dual aspect concept. Again, this is the basic principle of accounting. You must be knowing that accounting is debit and credit. So what is debit and credit? Each and every transaction has two aspects. So it is called dual aspect. You have to find out the two aspects. Then you have to logically apply the accounting rules, and then you have to pass the journal entry. Now, for example, purchase goods of rupees 12,000. What are the two aspects in the transaction? You have purchased goods, so you have received goods of 12 lakh, but you have to pay money worth rupees 12 lakh. So goods are coming in, cash is going out. So the business will receive something and the business has to pay something, give something. This is called dual aspect. Each and every transaction has two aspects and then they are segregated as debit and credit. This is called dual aspect concept. Next is accrual concept. Actually, there are two systems of financial accounting. First is cash system and second is accrual system. Now, as per cash system, when the transactions are paid in cash or received in cash, then they are recorded in the books of accounts. And in accrual system, when the transactions are due or accrue, they are recorded in the books of accounts. Actually, legally, accrual system is allowed in or followed by all businessmen in accounting. So, what is accrual system? Now, for example, paid rent rupees 25,000 of June. Suppose the month of June is going on and you have paid rent of 25,000. What does it mean? The transaction accrues in June and paid in June. So it will be recorded in the books of accounts. But how it accrue? Now suppose we will change the transaction. Paid rent rupees 25 of June in the month of July. Now what you will do in the month of June? As per cash concept, you cannot record this transaction because you have paid cash in July. But as per accrual concept, as the rent is due in June, it will be recorded in June. Now why this system is followed? Because due to this system, you get accurate figure of profit. Otherwise, there will be mismatch. So, accrual system is followed in the financial accounting. So, as per accrual concept, what you do when the expense or income accrues, it is recorded in the books of accounts. Cash paid or not, cash received or not is not considered. When it accrues, it is recorded. Now it is a related concept. Matching of costs and revenue concept. Now this is continuation of accrual system. For a particular financial year, you have to match both costs and revenue. And if they do not match, you have to make adjustment. So for example, rent of March paid in April. Now in India, we follow the accounting year 1st April to 31st March. This is the accounting year we are following, and the basic aim of financial accounting is to know the profit, to find out the profit or loss and assets and liability of this particular year. Now, listen carefully. Rent is of March, but it is paid in April, next financial year. But as per accrual concept, rent is of March, so you have to match it here. Rent is matched with March, but as it is paid in April, you cannot pass journal entry. The transaction has to be completed to pass the journal entry. So here you will make adjustment and it is called outstanding rent. If you do not consider the rent here and if you record it in April, the figure of profit will go wrong. So you will make adjustment of outstanding rent. Same way, the expenses which are prepaid or income received in advance, outstanding income, all these adjustments are made under this matching of costs and revenue concept, and the accurate figure of profit is calculated. Now one more concept is there. Verifiable objective evidence. Each word has meaning. Verifiable means which you can verify. Verifiable. Objective means it should be very clear. It should not be different for different person. And evidence means proof. Each and every entry in the books of accounts or journal has to be supported by objective proof. So for example, in case of entries of purchases, the invoices received will be the proof. In case of sales transaction, the invoices you have given to customers will be proof. In case any asset is purchased, again the bill received, checkbook, passbook, all can be verifiable evidences. But each accounting entry has to be supported by evidence, proof. So this is very important concept which is followed, and it helps in carrying out audit. So financial audit is compulsory by law, where all transactions are verified and then the auditor gives report whether the accounts are true and fair. So this concept helps in audit. Now after this, we are going to see conventions. Conventions means customary, which is followed by the accountants. They are called accounting conventions. Now first convention is convention of consistency. What does it mean? Consistency, the name suggests you have to be consistent. In financial accounting, you have to be consistent with the accounting principles or accounting methods. So this convention or customary means whatever accounting policies or whatever accounting principles you are followed, follow it consistently. For example, if you are using straight line method of depreciation, follow it consistently. If you are using written down value, follow it consistently. If you change it, your profit figure will go wrong. If you are valuing the inventory by FIFO method, first in, first out, follow it consistently. So wherever you are choosing any accounting method, particular accounting policy, follow it consistently. Then second is convention of disclosure. Now, this particular convention is more relevant to joint stock companies because in case of joint stock companies, the shareholder invests their money in the company and the company manages it and give returns to the shareholder. So they have to disclose each and every important fact to the shareholders. So there are various laws, Companies Act, Income Tax Act, SEBI guidelines, where certain points are given which must be disclosed to the stakeholders. So that is called convention of disclosure. Do not hide any important facts from the stakeholders. You have to disclose it to the shareholders. Then third is materiality. It is the extension of convention of disclosure. Only material facts should be disclosed. If you go on disclosing each and everything to the shareholders, to all stakeholders, they cannot find interest in knowing each and every fact. So material means important. What do you mean by material facts? Which affects the decision making of the user. So material facts must be disclosed to the shareholders. Last is convention of conservatism. What do you mean by conservatism? Conservatism means to have conservative attitude. What do you mean by conservative? Conservative means don't take risk. Play safe. You want to play safe. You don't want to take any risk. So you follow conservative attitude. Conservative attitude means we will take some example to know this. For example, we take book value or market value, whichever is less of closing stock. Why? Because as per this convention, don't book future profits, but consider future losses. So here, whichever is less you are considering. Suppose book value is 1 lakh, market value 1,20,000. Actually, you know, when you are going to sell this stock, you are going to book profit, you are going to earn profit of 20,000. But you want to have conservative approach and you will record stock at 1 lakh. So, as per this convention, don't consider future prospective profit, but consider all prospective losses so that your figure of profit will be conservative. Now, in case of loss, we will see there is a provision called RDD, Reserve for Doubtful Debts. In the debtors which are doubtful, you are going to provide for reserve because you may not realize that particular debtors. So, a percentage which you think after studying the average percentage of bad debts, you create reserve of doubtful debts for which you are doubtful. So, you are considering future losses, but you are not considering future profit. This is called convention of conservatism. So, all these accounting concepts and conventions together create accounting principles which are followed in preparing the accounting reports or which are followed in following all steps in financial accounting. Thus, in this unit, we have seen what is financial accounting, its functions, its objectives, and its principles. Now, in next unit, we are going to apply these principles and we are going to see how the books are prepared step by step. Thank you.